Welcome to Acera's pre-retirement seminar. So in the seminar, I'm going to tell you all the things you might want to know in the 3 years leading up to retirement, or maybe even the 3 months or 3 weeks leading up to retirement, because you're going to retire soon and you're going to have some questions like, what do you need to know? And what do you need to do? So I'm going to help you answer those questions today in this seminar, and I've organized my answers to those questions in the form of this checklist. So this is your pre-retirement checklist. I'm going to help you understand your membership. So I'm going to tell you a few things about how your membership works. I'm going to help you estimate your retirement benefit. I'm going to help you verify your retirement eligibility and tell you when you can become eligible to retire if you're not already eligible. I'm going to help you choose your retirement date. I'm going to show you what the application process to retire looks like. I'm going to help you understand the other benefits that we offer, such as medical, dental, vision. We'll talk a little bit about life events and signing up for Acera News. Okay. So, it seems like there are no questions so far, so let's jump right in. First of all, first item on the checklist, understanding your membership. So who is Acera? What is Acera? Acera is the Alameda County Employees Retirement Association in one sense. It's this acronym. But it's made up of a lot of people. So there's about 90 of us that work here. And what we do here is we provide retirement, disability, and death benefits to our members. So that's all of you. And you are a member of Acera because of the position that you work in and who you work for. So you work, or at some point you worked in a full-time retirement eligible position for one of the participating employers in Acera. These are the employers that participate in Acera's pension fund and that have decided that their employees need to earn the robust retirement that is Acera, that you earn when you're an Acera member. So how does Acera work? You as the employee, every time you get paid, with every paycheck, you pay into Acera's fund. So you'll see that in the before tax deductions line on your pay stub. So every paycheck you're paying into Acera's fund throughout your career. Your employer will also contribute to Acera's fund on your behalf. So they do that whenever you make your contribution. So we take that money and we invest it all over the world in a lot of different investments, and we earn interest on that money. And that's what gives us, between these three things, you contributing, your employer contributing, and the investment earnings, that gives us this big pot of money. So what do we do with that money in Acera's fund? So meanwhile, you are working and you are earning credit toward retirement. At some point in the future, you're going to retire, and at that point, you're going to start collecting a retirement allowance every month for the rest of your life. So you cannot outlive your Acera retirement. It's going to happen every single month for the rest of your life because you earned it. You spent your career earning that retirement. This is a slide that shows you, it's a timeline basically, and it shows you the different milestones that you will see in your membership with Acera. So the first milestone is your date of hire. If you started out in your full-time retirement eligible position, this was the first day that they told you to show up to work. If you started out like part-time or in another type of category, this would be the first day that you were in your full-time retirement eligible position. 2 weeks goes by, and then the first day of your second pay period, that's your date of Acera entry. So that's your first day of Acera membership, and that's when you start earning that credit toward retirement. 5 years goes by. After 5 years of full-time work, once you have 5 years of full-time service credit, or the equivalent of 5 full-time years of service credit, you're considered vested in the retirement system. And that word vested, that just means guaranteed. So when you're vested, you're guaranteed the vested benefits from the pension fund that you've earned. So you're basically guaranteed the guaranteed benefits. That's what vesting is. Okay, then at some point after you become vested, you become eligible to retire. And it has to do with how many years you've worked and your age. There are different scenarios where you can meet retirement eligibility, and I'll show you what all of those are later on in the presentation. Okay, so then at some point after you become eligible to retire, then you actually get to choose your retirement date. So you can work a long time after your retirement eligibility. You can retire immediately after your retirement eligibility. That's going to be up to you based on how much more retirement you want to earn. So you're going to choose that retirement date at some point in the future. But the timeline is not finished, because you start collecting your retirement allowance and you're going to be retired for hopefully a really long time before your death, which is also one of the milestones on the pension timeline. Sorry about that. It is inevitable. But the reason it's on here is because you're going to be earning your retirement you're going to be earning your retirement allowance between your retirement date and your death. And then there's an additional milestone on here, which is that depending on which retirement option you choose, and we'll go through all of the 5 options in the second half of the presentation, if you have a eligible beneficiary, they could receive a continuing payment after your death for the rest of their life. So that is also a milestone in regards to a SARA. Okay. So I do have a question here. The question is, let me go ahead and do that question because it'll be real quick. So the question is, how do you pay into a catch-up plan if you have not retired yet, but you're no longer employed? So it sounds like you've stopped working sometime between here and here, but you haven't retired yet. So there's an additional milestone for you, which is that you have terminated your employment. And what happens when you do that is you become what we call a deferred member. So you've stopped working, but you've deferred your retirement to a later date. If that's the case, there's no way to pay extra into a SARA or to earn extra service credit. You may be able to purchase some service credit as a deferred member that was previously purchasable. You would want to call into our call center and verify that I'm telling you the right thing, that would work. And we'll talk about that in a little bit, but that would be really the only way to do it. There's no real way to pay more into a SARA. That would be if you want to save more for retirement, that would be in your additional savings that you would want to do that. And that question, let me talk about that question in a few slides. Okay, so on to the next slide. This is a piece of the worksheet that I asked you to download. Let me show you the full worksheet. Okay, so this is the full worksheet, and I created this. We started doing this year, and the reason that I did this is because I've been doing this seminar for a lot of years, and I've had, especially when we were doing it live in our office, I've had people come up to me a lot and after the seminar and say, "Oh, the seminar was great. I never understood this stuff before now. This is my 3rd time." And I'm thinking, well, if you had to come 3 times, was it that understandable or was it that memorable? So this is my attempt to give you a takeaway. So this is your takeaway for this seminar. So you can fill this out as we go along, or you can watch the video later and fill it out. But I'm going to explain each one of these sections because as I talk about each of the concepts for how a SARA works and what your specific numbers are going to be, you can fill in your specific numbers in here. And then when you come back later to see what you might need to do or what you might need to know about your retirement, this is kind of what a kind of a summary of what you learned regarding your specific experience. So you can fill this out as we go along. So let me switch back to the presentation. So if you want to do it, if you want to fill it out as we go along, you can go ahead and fill in your SARA entry date if you remember it. Now, for all of these, the exact date isn't super important. You can just do approximate dates. This is just to kind of give you a broad idea of what your specific situation is. So if you happen to remember that it was, in November of, 2002, you can put that in. Or if you just remember 2002, you can put that in. Or if you do remember your exact entry date, you can put that in. You can also find it if you log into your account on our website. A lot of this information is in there for you. So you can go ahead and fill that in. If you want to, at this point, you could also fill in your projected retirement date. Like if you happen to, if you happen to have already chosen your retirement date, you can go ahead and fill that in so we kind of know what we're working with. If you haven't chosen it, I have a whole topic on helping you choose your retirement date, so you can wait to fill that in. And maybe for those of you who already suspect what your projected retirement date might be, maybe you'll hear something during the seminar that will change what that is. Okay, just really quick about vesting. I mentioned that it happens after 5 years of service credit. Those vested benefits are guaranteed by state law. And the vested benefits are the monthly lifetime retirement allowance and an annual cost of living increase to that retirement allowance. And additionally, there's a $1,000 lump sum death benefit that's considered vested. And there's going to be additional death benefits based on which retirement option you select, which I'll show you a little bit later. But this is just kind of an extra lump sum death benefit. So now that you know what your vested date is, which is going to be if you were working full-time between your entry date and you worked full-time for 5 years, it's going to be 5 years after your entry date, basically, or thereabouts. The vested date isn't super important. So if you don't quite know what that is, you can just kind of get close. Okay, so since we're talking about kind of the introductory material and pension basics, this is one thing that you will need to know throughout the presentation is what tier you're in. You're all in a tier, and it's based on that date of entry into a SARA. Okay, so here's how you find your tier. First, you figure out which line you're going to be working with here. Safety members are sheriff's deputies and probation officers and other sworn officers. If you're a safety member, you know it. If you're not a safety member, you're going to be a general member. So for all of our employers, you can look up here. For the Housing Authority, you can look here. If anyone here works for Livermore Area Recreation and Parks District, your timeline is not on here, and you can look that up on our website, or you can just say, hey, you can type in the Q&A, hey, I'm in Livermore Area Recreation and Parks District, help me out. So you could go ahead and do that, and I could help you out. Okay, so the way this works is, sorry about that, if you started work, if your date of entry into a SARA is before this date, July 1st, 1983, as a general member, you're in tier 1. If it's on or after this date, you're going to be in tier 2 all the way up until basically December 31st, 2012. That puts you in tier 2. If you entered a SARA January 1st, 2013 and beyond, you're in tier 4. For the Housing Authority, tier 1 stopped on September 30th or basically September 29th, 2011. Tier 2 started September 30th, 2011. And all the tier 4 in all the different categories, you're tier 4 if you started on January 1st, 2013. If you're a safety member, you're in tier 1 if you entered before July 1st, 1983. And then if you entered after that, that puts you into tier 2B all the way up until October 17th, 2010. If you entered on or after this day, in between these two dates, then you had a choice between tier 2C and tier 2D. And so you had to make a selection within, I think, your first 45 days of work in that safety position, and that puts you in one of these two tiers. If you didn't select one, then I think you were you were defaulted into whatever the lower tier was. Um, and then if you started January 1st, 2013 and beyond, that would put you into tier 4. Okay, so now you all know what tier you're in. And so you can go ahead and mark that off on the worksheet. If you are a safety member, you might have two tiers. You might have done some general work, and and then you have your safety tier. You're going to have a split tier, which means when we do your calculation, we're going to do one calculation for the general time and another calculation for the safety time, and then whatever dollar amounts come out of both of those retirement formula calculations, that becomes your retirement allowance. So you can either do one worksheet for each one of those times, or for each of those times, or you can just kind of mark your both tiers on this one worksheet. Okay. Next item on the checklist is estimating your retirement benefit. So here's how your retirement benefit is going to be calculated when you go to retire. In retirement, you are going to receive, as your lifetime monthly retirement allowance, every month you're going to receive a percentage of your highest salary for each year of service that you worked during your career. So let me kind of get into that a little bit to help explain what all that means. Okay. Let's say you're going to get 2% of your highest salary for each year of service. And let's say that you work for 20 years, you earn 20 years of service credit. Okay. That means for each one of these 20 years, you're going to get 2% of your highest salary in retirement. So that means you're going to get 40% of your highest salary in retirement, because 20 years times 2% is 40. 2% for each one of those 20 years is 40. That's 40% of your highest salary. Now let's say your highest salary, just for an example, and a nice round number, let's say your highest average monthly salary was $5,000 per month. So you were making $5,000 per month basically while you were working. Well, in retirement, you're going to get 40% of that, which is $2,000. So that's how the pension formula works. You can see that the higher any of these numbers are, so the higher your age factor percentage, so the higher your years of service, the higher your salary, because it's a multiplication, that's going to equal a higher monthly retirement allowance for life. So when I said earlier in the presentation that you're earning your retirement, you're earning it in these three categories. You're earning it by getting older, so the older you are, the higher the percentage you get. You're earning it by working and earning years of service credit. And you're earning it by just having a salary, and the higher your salary is, the higher this multiplier is going to be in the formula. So let me talk about each one of those factors in the formula. Let me talk about the age factor percentage first. So I said that you're going to get a percent of your highest average salary for each year of service. The percent that you're going to get is going to be based on your age at retirement. So it's not going to be that 2% that I showed you in the example. That was just an example. It's going to be based on what age you retire at and what tier you're in. So to find yourself on this chart, find what your tier, you just need to know what tier you're in based on the slide that I showed you a few slides ago. So again, if you're a safety member, you're going to look over on this side. If you're a general member, you're going to look over on this side. And then you can just narrow it down to the one tier that you're in. So a lot of people are general members in tier 2 who are getting ready to retire these days. And so I usually use that as an example. So if you're a general tier 2 member, you're just going to look at this column and forget about all the other numbers. And if you're like a safety member, or you're in tier 1 or tier 2B, you would look at this column, you forget about all the other numbers. Okay, So let's say that you're a general tier 2 member and you're going to retire at age 60. What we're going to do for the formula to determine what your age factor percentage is we're going to come over to this chart. We're going to go down to age 60. We're going to come over to tier 2. We're going to see that it's 1.92%. That's the percent of your highest salary that you're going to get for each year of service. That's what we use in the formula for you. So one thing that you may notice about this chart is that the numbers get bigger the older you are when you retire for all of the tiers, up to a maximum for each tier, which is represented by the blue box. So for tier 2 general members, the maximum age factor percentage that you can get in the formula is 2.43% at age 65. If you retire at 65, you get that. If you retire at 66, 67, you get that. If you retire at 77, you get the 2.43%. So if you retire over the maximum age for your tier, you're just going to get whatever the maximum age factor percentage is for your tier. It stops going up at that age. Okay. Another thing that you might notice about this chart is not all the ages are represented here. I skipped a bunch of them. And that's because they all don't fit on the chart because there's so many. And there's so many because the percentages actually increase with every 3 months that you don't retire. Every 3 months you increase in age, there's a slightly higher age factor percentage. So if this was the full chart, it would say 50, 50 and a quarter, 50 and a half, 50 and 3/4, 51, and so on and so forth. So every 3 months, every quarter year you wait to retire, you go up 1 notch in this age factor chart. Okay. If you ever want to see what all the age factor percentages are, you can check that out on our webpage, and we have the full chart for you. And so you can dig in down to what your quarter age is going to be. It's based on your birthday. So if your birthday is, let's say your birthday is January 15th, 1 quarter after your birthday is April 15th, so 3 months later on that same day, 2 quarters is July 15th, 3 quarters is, let me see, August, September, October 15th, and then back to your January 15th birthday in this example. So that's how that works. Every time you pass one of those days, you go up 1 notch in this chart. So that's how the age factor percentages work. Okay, so in the retirement formula, we talked about the age factor percentage. Let's talk about the next factor in the formula, service credit. So this is about you earning your service credit, and it's measured in years. So you're going to earn service credit between your first day of Acera membership, and you're going to earn it all the way up until you retire. If you stop working before you retire and maintain your Acera membership as a deferred member, then you would stop earning service credit when you stop working. But if you work straight into retirement, you're going to earn service credit all the way up until the minute you retire. So if you work full-time for 20 years, you would earn 20 years of service credit. If you work for 20 years and 15 minutes, you would earn 20 years and 15 minutes of service credit. So we calculate it down to the fraction of a day, and you get all of that fractional time in the formula for you. So if you look at your service credit number, if you log into your account on our website, and your service credit number says like 15.87526, all those decimal places are calculating your service credit down to the fraction of a year, and you get all that in the formula for you. So you earn service credit the minute you become an Acera member, and you start working all the way up until you stop working. Okay. You earn service credit while you work during your regular work hours. You also earn service credit during your earned vacation and sick leave, management leave, comp time, holidays, floating holidays. So you earn service credit during all of those times. Those don't count against you. You're out on your leave, you're earning service credit. You do not earn service credit during these times. If you're ever out on leave without pay, you're not earning service credit. If you purchase additional vacation, which is on top of your earned vacation, you don't earn service credit while you're out on the purchased vacation. Also, if you sell vacation, you don't earn service credit for the vacation that you sell back to your employer to get more money, but you may be able to get salary credit for that, which we'll talk about a little bit later in the presentation. And then you don't earn service credit for overtime, on-call time, or standby time. So there are some eligible types of time that you may be able to purchase to increase your amount of service credit in the formula, which increases your retirement allowance. And those include any part-time work that was just plain old part-time work that you didn't get service credit for. And that's usually if you started out working part-time in your job. And we're not talking about you're working for a temp agency or under contract, you're just working part-time. That time is purchasable because you did not earn service credit until you got your full-time retirement eligible position and became an ACERA member. So you can buy that part-time work. Also, the county's temporary assignment pool, also project work before your full-time work. They also talk about seasonal work, service as needed, and there's a few other categories you can look at on our service credit page on our website that are kind of similar to this. There's also the days before your entry date, which is the days between your date of hire, the 2 weeks between your date of hire and your date of ACERA entry. That is purchasable time. If you ever go out on unpaid leave during your membership, including medical leave, disability leave, or military leave, once you return from those 3 types of leave, you can buy that time up to, for the medical and disability leave, it's up to a year per instance. Just plain old unpaid leave, also known as leave without pay, you can't buy that time. It has to be in one of these 3 categories. And then there's also redepositing prior memberships. So if you used to work as an ACERA member in the past, and then you left and you took a refund of your employee retirement contributions, and now you're back working here again, you can redeposit that money to get your service credit back. An additional category for that is if you got divorced or you dissolved a state registered domestic partnership, and part of your ACERA service credit and contribution balance went to your ex-spouse, if they take a refund of that contribution amount, you can actually buy that time back by putting that money back in. So you can redeposit that money, but only if they take a refund. And there's also this category right here. If you used to work for another public agency in California and you are not eligible to collect a pension from their pension fund, you can buy that time as a ACERA service credit. So I'm not going to dive deep into service credit purchasing because it's kind of a big topic, and we cover that on our website, and we cover that in our new employee and mid-career seminar. So we have those videos out on our website if you want to just get into that topic at that point, or you can check out our page on purchasing service credit on our website, and there's a kind of a deeper dive into this topic. There's a question that I have. Can you buy back time if you're no longer employed and not retired yet? So you're a deferred member. Can you buy the time? I think you can. But I'm not 100% sure. So that would be something that you would want to call into our call center or write into us. If you go to our contact page on our website, you can just write in that question, and they would they can answer that for you. Sorry, I don't know that off the top of my head. And yeah, regarding the question, can you buy the medical leave while you're in deferred status? I think, like, again, I think you can. Like, if you went out on unpaid medical leave and then you return to work and then you quit your job, I think you can. But yeah, you would want to write into our write in on our contact page and ask that question just to verify that. Okay. Since we're talking about service credit, this kind of falls under that umbrella. What happens if you have sick leave still on the books when you stop working and or retire? Okay. So what happens to your unused sick leave? So if you go straight into retirement, that means that your last day of work is the day before your retirement date, your first day of retirement. Okay, so that's going straight into retirement. This is your last day in active pay status for your ACERA covered job, and this is your first day of retirement. we will convert your sick leave to service credit on a 2-to-1 basis. So that means that you're basically going to get half of your sick leave as service credit, but there's a cap on it. And the cap is in your memorandum of understanding, which is what MOU stands for. So you have to see what the cap is for you. But you can get half of your sick leave as additional service credit up to the cap, and we'll calculate that automatically for you and add it to your service credit. A lot of the MOUs, and a lot of them, the cap is 125 days of sick leave. So if you had 125 days of sick leave on the book, for example, we divide that in half, that gives us 62 and a half days of additional service credit we would add to your amount of service credit for the retirement calculation, which is about 12 plus work weeks. So you would get about 12 plus work weeks, which is about a quarter a year additional service credit in that example. I don't know what all of the MOUs, what the cap is for all the MOUs off the top of my head. I do know that ACMEA, there is no cap. And then for unrepresented members who follow ACMEA, there is no cap. But any sick leave that you have over the cap, you would just lose. Okay, if going back one slide, if you become a deferred member, which is you stop working before you retire, if you spend any days as a deferred member, you just lose all your sick leave. So you don't get to do the sick leave conversion. So for, let's see, I have a couple of questions here. Okay, one is about retiring April 1st. I'll answer that later. One is about so sick leave versus PTO. So since you're talking about PTO, I'm assuming you're working for Alameda Health System, where they lump your sick leave and your vacation leave into one category, which is known as paid time off, PTO. So I think the way this works is that you have this additional bucket, which I think is some kind of catastrophic sick leave. And that is what we're talking about when we're talking about the conversion. For your PTO, you will probably be able to get salary credit for it, which we'll talk about when we talk about the salary component later. There is additional information specifically for Alameda Health System on that service credit purchase page in regards to what happens to your unused sick leave. So I think it's a good idea to check out that paragraph, those paragraphs about Alameda Health System just to make sure I'm not telling you the wrong thing about that. Okay, so we talked about the age factor percentage. We talked about the years of service credit. Let's talk about the highest average monthly salary component of the formula. Okay, so when you go to retire, we're going to need to calculate what your highest average monthly salary is from your career. In order to do that, what we do is we find this period of time called a final compensation period, which is the time that we're going to examine, the time period in which we're going to look at all of your pay during that period to figure out how much you made on average during that time. For tiers 1 and 3, it's your highest consecutive 26 biweekly or 12 monthly pay periods. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. So it's depending on if you're paid biweekly or monthly. That means that for tiers 1 and 3, it's essentially your highest year of pay. And for tiers 2 and 4, it's essentially your highest 3 years of pay. What we do is we look at your total pay during the final compensation period, either during that highest year or that highest 3 years. And to get the average, we're going to divide the average that you were earning per month, we're going to divide by the number of months in that period. So we're going to divide your highest pay over 1 year by 12 months for tiers 1 and 3. For tiers 2 and 4, we're going to divide your total pay over 3 years by 36 months. And that gives us the average amount that you were making over that time. That's your highest average monthly salary. And that becomes one of the multipliers in the retirement formula. So what pay is going to go into, is the highest based on gross or net? It's gross pay. Okay, so we're talking about gross pay when we're talking about your highest average salary. So what types of pay are we talking about? We're talking about your base pay, of course. And then We may also be talking about some other pay codes, sometimes known as footnotes. These are often based on skills and education that you have additional pay codes. I can't tell you off the top of my head whether your pay code is going to be in or out of this calculation because there's like 1,000 of them. What you can do is go to this page on our website and pull up the PDF for your employer, and there's a grid there that has all the pay codes listed, and it says yes or no whether your pay code is in or out of this calculation. I can tell you that overtime never counts. Overtime pay never counts. Okay, so then for tiers 1 and 2, not tier 3 currently, and not tier 4 ever, there are some additional types of pay that can be included in the salary calculation. And those include vacation sales and vacation cash out. Okay, so this is kind of, we're going to talk a little bit about this. We're going to kind of go into detail about this because people like to plan this out and really understand this. For tier 4 members, you can go ahead and take a snooze. Sorry, that tier 4 members are not included in this, and that's because when the state passed their Pension Reform Act back in 2012, they specifically left tier 4 members out of this, so this type of pay can't be included in your calculation. But everyone else, here's how this works. Okay, so there's 2 ways. So you earn vacation, right? Vacation is one of your earned benefits. And it's also a benefit that if you don't take it, they will pay you for it. They'll write you a check for the vacation that you don't take. Now, you can get paid for your earned vacation during 2 different times. There's 2 different categories of time that you can get paid for your earned vacation. That's vacation sales and vacation cash out. Vacation sale or vacation sell is when you sell your vacation back to your employer while you're still employed. So while you still have your job, you sell your vacation back to your employer, and that's vacation sell. Vacation cash out happens at the time that you stop working, at termination, or if you're working straight into retirement, it's at retirement. So if you have vacation left over on the books when you stop working, they'll cash you out for it at that time. Okay. Now, when we're discussing this vacation compensation, we're talking about the vacation compensation that happens during this final compensation period. If you sold a bunch of vacation years ago when you were making less money, and that's not going to be included in your final compensation period, that's fine. You got paid for your vacation back then, but that's not what we're talking about. It's not going to be included in here. We're talking about the vacation that you sell and or cash out during this final compensation period. And for most people, this final compensation period happens at the end of their career because they're making their highest rate of pay at the end of their career. But sometimes that's not the case. And if your final compensation period is earlier and you sold vacation during that time, that could be included in this calculation. Otherwise, if you didn't sell vacation during that time, then that won't be included. Okay. Excuse me. So we're talking about the vacation that you're getting paid for during your final compensation period. So we're going to add the 2 together, and that's going to be your total vacation compensation during this final compensation period. Okay, so the idea here is that if you get paid for your earned vacation that you're not going to take, and that pay happens during that final compensation period, that makes your total salary during that final compensation period go up. If your total salary goes up during your final compensation period, that means your average salary over your final compensation period is also larger. If your average salary is larger, your highest average monthly salary, because that's one of the multipliers in the formula, that makes your retirement allowance increase by a little bit. So the bottom line here is that selling vacation or cashing out vacation will cause your retirement allowance to increase. Okay. How much might it increase if this is your situation? So that's depicted in this chart here. So if you're in tier 1, and let's say that you're able to cash out or sell, so you have a combination of vacation compensation, and let's say that it's 8 weeks worth of vacation that you get paid for during your final compensation period, that will increase your retirement allowance by about 5% at the time of retirement for the rest of your life. Um, so that's a lot of people um, are able to do that. If you're able to do like 12 weeks, that would be basically 7.5%. If you're able to get up to 15 weeks, almost 10%. For tier one, the percentages are a little bit compacted because we're talking about a year's worth. So if you were able to get paid for 3 years worth of or 3 weeks worth of vacation pay, that could increase your retirement allowance by 5.8%, and so on and so forth. These are all approximate. It's not going to be exactly this, but this is just to give you an idea of the effect of selling and cashing out vacation on your retirement allowance. Okay, so there is a cap on how much vacation compensation a SARA must include um, in your retirement calculation. And the cap is defined by state law. Okay, so this cap exists out there. And what the law says is that a SARA must include, if you get paid for your earned vacation during that final compensation period, a, a SARA must include that vacation pay in your salary calculation, but we have to cap it at a certain point. So there's a limit in the law on how much of this vacation pay we can include in your salary calculation. So some people will, who are looking in from the outside, will say, well, they're getting a little more retirement based on like a higher pay than they were getting prior to retirement. Not really, because it's this is, first of all, this is in state law. So this is how the state says this is supposed to work. Plus, it's compensation that you're receiving. It's your it's your pay that you're receiving while you're still employed, and we must calculate your retirement based on your pay. So that's how that works. So I'm going to help you find the cap for you. And before I do that, let me just review the questions that I have here. Okay, so there's a question: does total salary include bonuses? Maybe, and that would be one of those pay codes that you would want to check on that pay code page to see whether that is in or out of this calculation. There's a question: does the year start July 1 for calculating your final 3 years as a safety member, or basically any member? Let me address that question real fast. Okay, so this final compensation period here, this is not based on the fiscal year. This is not based on the calendar year. This is based on your exact situation. This is based on your period of highest pay. So if you, let's say that you're making your final pay, your highest pay at the end of your career, your highest rate of pay at the end of your career, and let's say that you retire on September 1st. That happens to be the retirement date that you choose, because you're going to get to choose your retirement date. Well, what we're going to do, let's say you're in tier two, what we're going to do is we need to calculate we need to figure out what your final compensation period is. We're going to look at your payroll records that we have in our pension database that your employer has transmitted to us so that we can do these calculations. And we're going to find that your periods of highest pay are those 78 biweekly pay periods leading up to September 1st, your date of retirement in this example. And so your final compensation period is going to be the 3 years preceding that around the calendar. So it's going to be based on just whatever your consecutive periods of highest pay are anywhere in your payroll records. That's what becomes your final compensation period. There's a question regarding Are there any additional benefits for those no longer employed who were in management? So you're a deferred member, you were a manager. Um, Not that I can think of. Um, the only the only one really was that um, that during that sick leave conversion, if you're in ACMEA, which is a management union, that there was no cap on the amount of sick leave that could be converted to service credit. But I can't think of any more. Okay, so back to the discussion of caps in um, how much vacation we can include in your salary calculation. Okay, so get out your worksheet, or you can just follow along and you can just do this later. So the first thing I'm going to do is for Alameda Health System employees, I'm going to help you find your cap, and then I'm going to do everyone else. So you'll see on your worksheet that there is a section for calculating your vacation compensation limit for tiers 1 and 2 for Alameda Health System employees. Okay, so what you're going to do is you need to know how much PTO you earn per pay period. So you put that in this blank. So let's say in this example, you earn 6.7692 hours of PTO for each pay period. So for each biweekly pay period. So you would put that in the blank here. What you're going to do for tier 1 is you're going to multiply the number by 26. Basically, you're multiplying it by 26 pay periods in 1 year. That's your limit. So your limit would be 176 hours of vacation pay includable in the salary calculation. For tier 2 people, you're going to multiply it by 52, which is 52 pay periods basically. And that gives you, in this example, 352 hours. So these three numbers are just this example. You're going to have to do it on your own. But this is the maximum amount of hours of vacation compensation we can include in your salary calculation. So if you wanted to figure out how to maximize your retirement based on the state law that I just shared with you, what you would do is simply try to have this limit on the books when you retire. You don't need to worry about selling vacation before retirement. You just simply think about having this limit on the books when you retire. If you don't have the whole limit, don't worry about it. If you don't have any on the books when you retire because you just want to take all your vacation, don't worry about it. Because this gives you this increases your retirement by a small amount, gives you a little boost, but if you can't do it, don't worry. You're just going to get the retirement that you earned. Okay. So the question is for AHS, it's 100% of those hours. It's not 50% or related to the maximum sellback. It's not. So this is how it works. And we previously on our website, you're probably remembering how we used to explain it on the website. We thought it was 50% of the hours, but then I went and really ran the numbers and found that it's not. It's based on, for tier 1, it's based on 1 year's worth of PTO, and for tier 2, it's based on 2 years worth of PTO. And it's 100% of those hours, not 50%. So you stop earning at 432, but this calculation gives you 576. Are you in tier 2 and you stop earning at 432? Does that mean they won't let you earn any more hours than 432? They won't let you have any more than 432 on the books? Okay, so you're not allowed to earn 2 years worth. You're not allowed to keep 2 years. Okay. So that is a limit I didn't know about, that they won't let you keep up to 2 years worth on the books. So in that case, your limit is going to be whatever they will let you keep on the books. If they won't let you earn more than 432, then that's going to be what the limit is, because the law says that we have to limit it by what's earned and payable. And since you're not allowed to earn more than, they won't let you earn more than 432, then that's going to become your limit. Okay, so sorry about that. So you would just simply want to have that on the books when you retire. Okay, so that's Alameda Health System. Yeah, the comment is that's a drag. Yeah, combined with no raises. Tell me about it. Sorry about that. Yeah, sorry that they put you in that situation. Okay, so non-Alameda Health System employees. Here is how you figure out your vacation compensation limit for this salary calculation. So you're gonna go to this section on the worksheet and you're gonna fill in these two blanks. This first blank you're gonna fill out with how many weeks of vacation you earn per year. And it's the number that you're earning at retirement. So if you have been working for 20 years and you're gonna get over that 21-year mark, and you're gonna go up from earning 4 weeks per year to 5 weeks per year, and you're gonna retire shortly thereafter, you would put in the 5 weeks. So it's the weeks of vacation you're earning at retirement. In this example, we're gonna use 5 weeks of vacation. In this blank, you are going to put in how many weeks of vacation they will let you sell per year. Your employer has a rule somewhere of how many weeks of vacation they'll let you sell. Some employers will let you sell 1 or 2 or 3 weeks of your earned vacation per year. Sometimes it's based on what your position is for the same employer. So sometimes non-managers will be allowed to sell 2 and managers will be allowed to sell 3. So if you don't know what it is, you can ask your payroll clerk and they will let you know what that limit is. So for this first example, we're gonna say that the limit is 2 weeks worth of vacation that they'll let you sell per year. Then what you do, you take those two numbers and you look at this chart and you find where they intersect on the chart based on your tier. So in this example, you're earning 5 weeks of vacation per year and you're allowed to sell 2. And so you come over to this row so let's do a tier 2 example since most people are in tier 2, and your limit is going to be 8 weeks worth of vacation pay is the maximum amount of vacation pay we can include in the salary calculation. And so you would put that limit in this blank here. So you get the limit from the chart. Some people, you earn 4 weeks and you're allowed to sell 3, you'd come over here, your limit's 12. If you earn 5 weeks, you're allowed to sell 3, come over here, your limit's 12. Or if you're in tier 1, your limit's 5. So this is how that chart works. Okay. So now you know what your limit is. You put that in the worksheet. Okay, so what do you actually do with that limit? Okay, so let's say that if you want to maximize the amount of vacation pay includable in your salary calculation, and this is your limit, that means that if you have 8 weeks of vacation on the books when you stop working and or retire, we would include all 8 weeks of that in the salary calculation for you, and you don't have to sell any. So you just sell 0, okay? Let's say, and so in this situation, it's real easy because your limit is 8, you can just cash out 8, and you just don't have to worry about selling any vacation, just have 8 weeks on the books when you retire. Okay, now let's take a different example. A lot of people are in this situation. You're earning 5 weeks of vacation per year at retirement, and you're allowed to sell 3 weeks of per year vacation. Per each year, you're allowed to sell 3 weeks of vacation. So when you get your limit from the chart, it's going to be 12 weeks. Okay, now your employer has this additional rule that comes into play here. They will not let you cash out more than 2 times your accrual rate of vacation. So in this example, this person earns 5 weeks of vacation per year. 2 times their accrual rate is 10 weeks of vacation. They won't let you cash out more than 10, but your limit is 12. Okay, so if you're trying to get up to your limit, you can't get there through the amount that you can have on the books when you retire. So then you would have to sell a vacation if you're trying to get up to this limit. Okay. If you had more than 10 weeks of vacation on the books when you stopped working and or retired, like let's say you had 11 weeks, that extra week of vacation above the 2 times your accrual rate maximum, that would just go poof. That would disappear. It would dissolve. You don't get salary credit for it, you don't get money for it, you don't get service credit for it, it just disappears. Okay. So, in order for that not to happen, you would either want to take the vacation before you stop working, or if your goal is to maximize this, get up to this limit that is written in the law for you, you would just sell the vacation prior to retirement. And if they'll let you sell it even like a few weeks before your retirement, you could do that as well. So in this scenario, you're selling what you can't get up to. Uh, you can't get up to your limit, so you're selling the difference. Okay. Now, what if you already sold a bunch of vacation? So a lot of people, there was this kind of old knowledge before 2012 where you needed to start selling vacation your last 3 years of work, um, in order to get up to whatever your limit was going to be, or maybe in the last few years before your retirement, you just needed some extra cash and you just wanted to sell your vacation. What if you already sold a bunch of vacation? Okay, so let's say that you actually that in the same scenario, you sold 6 weeks of vacation. Okay, rather than the two that was in sorry, rather than the two that was in the previous example. Let's say that you sold six. Okay, so you have two options here. Your first option is you can just cash out the difference, which means that you know what your limit is because you're watching this pre-retirement seminar. Okay, and then so you know what your limit is, and now you know how much you sold. Okay, if you don't remember how much you sold, you can go back to your payroll records and figure that out. So you put that in here, and then you just simply have the difference on the books. So you just have whatever is left over on the books before to get up to your limit. So in this example, you sold six, you just have six more on the books to get up to the 12. Okay, that's option number one. Option number two is that you already sold the six, but if you just want to have more on the books for whatever reason, up to 2 times your accrual rate, that's okay. So even if you had up to 10 weeks of vacation on the books and you retired, that would be okay. Now, 6 plus 10 does not equal 12, it equals 16. So the law tells us for this person, in this scenario, we have to limit it to 12. So we're not going to put 16 weeks of vacation pay in the salary calculation. We're only going to put 12. But which 12 is going to be determined by basically how much you got paid for those weeks of vacation. So we're going to look for the maximum week, the weeks where you got paid the maximum, and it's probably going to be this 10 here, because over that 3 years time, you were probably getting, in this tier 2 example, you were probably getting cost of living increases and raises, maybe. And so when you cashed out vacation, you got paid a little more for it than what you sold previous during that 3 years. And so we'll take 10 weeks, this 10 weeks plus 2 from here to get you up to the 12 weeks worth of vacation pay to put in the salary calculation. So that's what we would do. Now, the 4 extra weeks from back here, that went into your bank account. In fact, all of this money went into your bank account. This 6 weeks, whenever you sold it, that money went into your bank account. This 10 weeks that you cashed out, that money went into your bank account. You still get all the money, even if you sell more vacation than is your limit, you still get all the money. It's just that we cannot include more than 12 weeks worth of that money in this example in your salary calculation. We can't consider more than 12 weeks worth of vacation salary as part of your total salary during your final compensation period. So it's the act of getting paid for vacation that gives us the numbers to be able to calculate how much salary you earned over that period. In a different example, maybe you're just not going to go for the limit. Maybe you're just going to cash out a couple of weeks of vacation because you already took most of your vacation, and you're going to have 2 weeks of vacation on the books when you retire, and that's it. That's fine. We'll put those 2 weeks of vacation into the calculation for you as long as it's not over your limit, and it'll boost your retirement allowance by a small amount. So that's how that will work. Okay, so that's our discussion of the effect of vacation pay on your salary calculation. So tier 4 members, you can feel free to come back if you took a little nap or you were over in the kitchen getting coffee or whatever. Welcome back. Let me just check on the questions here real fast. Okay, so this question is from a deferred member, and first of all, you're saying that your employer made it really stressful when you left. Sorry about that. I apologize that that happened to you. That sounds difficult. Um, but the result is that you have no idea like how much you had left over on the books, um, or how all that worked, like how much PTO you had, um, and how much you got. I guess how much you got cashed out for, because it's the cashing out of the PTO that, or maybe even you sold some and you don't remember like how much happened because you're a deferred member and it happened long ago. Um, so the way to figure that out, if you're curious about it, is let's see. The main way to do it is if you still have your payroll records, you just can look back through your payroll records, and if they cashed you out for some, you'll see that in your final check, your final pay stub. If you don't have those records, um, that could be something that you can ask our staff about, because we have your payroll records. So you could either call into our call center. Um, during this time, this pandemic time, we're answering live calls on Tuesdays and Thursdays. By the time you're watching this video, that may change, and we may be back to 5 days a week. But if you leave a voicemail, what we're doing is currently we're answering voicemails within 24 hours. Alternatively, you could go to our contact page and write in the question and ask about that PTO. Probably what will happen is they can look through your payroll records and they'll send you a letter in the mail telling you just to keep it all secure so that we're not um, putting out confidential information over the phone. But that would be one way to figure that out. You don't really, I mean, honestly, you don't really have to know, um, because it's um, it's going to be calculated for you automatically anyway, because we're going to see it in your payroll records, and so you will get that little increase anyway. Um, So if you just want to have like a nice conservative retirement benefit estimate, if you log into your account on our benefit estimator, um, and just do the benefit estimator, it would just give you like a nice conservative estimate without that additional. And then if there is PTO that was cashed out, you would get a little nice surprise in your final calculation when you get your check. But if you're curious, like I said, you can write into us. Okay. Yeah, and if you want to double check that we have that pay on file for you, that would be another reason to write in or call in. Okay, so let me talk about this real fast, and then we'll take a short break. Okay, so there are some benefit limits on your monthly payments. So I'll just touch on this really quickly because most people do not hit these limits. The first limit is that you can't receive more in retirement than you are earning as a working employee. So that means that your retirement allowance is capped at 100% of your highest average monthly salary. So that's what the first statement that I made is kind of true, because your highest average monthly salary can be a bit higher because of the vacation pay that we were just talking about. But for the vast majority of people, you're not going to hit this cap, because you have to, for tier 2 members, you have to work like 40 some years. For tier 1 members, you have to work 30 some years. For safety members, it's often 30 some years, and be over a certain age and hit your maximum age factor percentage. So most people do not hit this cap of 100%. The vast majority of our members, and in fact, our average member retires with 20 years of service credit. So you won't be anywhere near the cap of 100% of your working salary in retirement. Now, these two are for people who are earning high salaries. So I'll let you, review that on your own. And so it depends on if you entered a SARA during these periods, whether you hit these caps. So you can check that out. For tier 4 members, there is a cap on how much of your annual wages we're allowed to consider for the salary calculation. So this is an annual wage number. For general members, it's this number. For safety members, it's this number. So for general members, it's 126,000 plus. For safety members, it's 151,000 plus. These numbers go up every year as the Social Security wage index limit goes up every year. So if you're going to retire in a few years, these numbers will be a little bit higher. But sorry that this cap exists. This is something that was in that state pension reform law. The good news about it is that we are not going to take retirement contributions out of your pay beyond your salary. If your salary goes above this amount, we're not going to take retirement contributions out on any salary you earn above that. And so you're going to have extra salary in your paycheck to be able to save additional money in your 457B or whatever investments that you want to save it. Okay, let's talk about estimating your retirement. I'm going to show you 2 ways to do this. There's 2 different options for this on the worksheet. The first option on the worksheet is getting this ballpark estimate. So it's going to use one of our income replacement tables to figure out what percentage of your salary that you're earning before retirement you're going to get in retirement. So here's how you do this. So you think of your retirement scenario. If you don't know exactly what it is right now, you can just kind of think of what age you're going to, like, I'm going to retire in 10 years or I'm going to retire in 2 years. What age am I going to be at that time? So you put in your age here. Let's say in this example, it's 58. And then you put in how many years of service credit in just round years you will have earned at that time that you retire in this retirement scenario. So in this example, it's going to be 29. So then what we need to do is we need to go out to our website and look at the ballpark estimator chart. So let's go out there. So currently the way to get there, and we're about to relaunch our website in a few weeks, maybe about a month, is so it'll look a little bit different, but it'll be easy to find on there. The current way to do it is to go down and get a retirement estimate. And then there are these income replacement tables. Okay, so let's just pick on the tier 2 general members again. So you open up the table and you find out where those 2 ages intersect. So if we are, in the example, it was age 58 and 29 years of service credit. So we'll go down to 29 years of service credit. We'll come over to age 58, 50.03%. So right here. So that means that in this scenario, you will get 50% of your highest salary in retirement. So then we go back to the table on the worksheet. And we put that in right here, 50.03%. So then we put in a estimate of our highest average monthly salary. So you can do this a few ways. If you happen to have logged into your account, your personal account on our website recently, and you used the benefit estimator and it gave you an estimate of your highest average monthly salary, you can put that in here. If you just kind of want to do kind of like a ballpark math or like back of the envelope math, and you just kind of think about how much you earn per month currently, you can put that in here. Be careful with that because maybe you got raises over the last 3 years, and so what you're earning now, your average over that last 3 years, if you're in tier two, might be a little bit less. Um, so yeah, you can just kind of put a ballpark in here, and then what you do is you multiply uh, your salary times the percentage, and you get your ballpark estimate. So this is what you were making before retirement, and this is what your retirement allowance is going to be because it's 50.03% of this number. Okay. Um, and if and for those of you who don't do any math and forgot all your math, that's fine. All you do is you take this number and you multiply it by 0.5003. So you just move the decimal place 2 places this way and multiply those together, and that'll give you this. Okay, that's that's method number one. Okay, that gives you kind of a close ballpark estimate. Method number two is using the benefit estimator in your account on our website. So what you do is you log into our website. You can type in this URL here, acera.org/WMS, or you can just go straight out to our website and press the account login button. And if you haven't created an account there before, you can go ahead and create one, and you'll find that once you get in there, all your pension data is there ready and waiting for you. So once you get in there, you're going to be putting in these two numbers, separation date and projected retirement date. So let me go out to some screenshots here. So this is the account login button on our website. And then once you get logged in here, it's what our member portal is called Web Member Services. And the first thing that you're going to see is this account summary screen where it has a lot of the pension data that we have for you. And then you're going to click Estimate a Benefit over here to get to the benefit estimator. So we're talking about these two numbers right here, your separation date and your projected retirement date. Your separation date is your last day of work or inactive pay status. That you can be on leave that day, that's fine. Your projected retirement date is your first day of retirement. Okay, so you're going to be doing a scenario here. And if you don't know exactly those days, you just pick a couple of days in the future. Like you're going to retire 3 years from now, so you just pick a date 3 years in the future as your projected retirement date. And if you're going to work straight into retirement, you just pick the day before as your separation date. Because this is just a scenario. Okay, so then just to zoom in here on the pertinent information, so you're going to put those dates in and hit calculate, and it's going to give you a projection of how much service credit you will have earned in this scenario that you're doing. It's also going to give you a salary projection for your highest average monthly salary. You have the opportunity to override both of those numbers if you like. Okay, so if you are in the middle of a service credit purchase contract, you don't get credit for that until you finish paying for it through your monthly payroll deductions. So whatever the amount that you're buying is, you could add it to this number. Or if you wanted to see the effect of that sick leave conversion on your retirement allowance, you could add that here too. So in that example I gave you way at the beginning of the presentation, there was an example where you got a 12 additional weeks of service credit based on us converting half of your sick leave into service credit. Well, 12 weeks, that's about a quarter year. And a quarter in decimal places is 0.25. So you just take 0.25, add it to this number, and put the grand total in here to override your service credit. So that's how you do that. And then you can override your salary here. If you're going to retire many years from now, maybe you want to see what having a higher salary, you can multiply some inflation numbers in here per year for the next however many years until your retirement and increase your salary here just to see what the effect is. This salary is based on an average of what what the software is using your current payroll records. And then if your final compensation period is going to include any pay periods in the future, it's going to use your last payroll record on file to fill in those future dates. So it's not going to increase your pay So there's no pay increases. It's not projecting pay increases for this, this salary figure. Okay, so then what you're doing here is you can put in some beneficiary information here, and you can hit get estimate. Okay, so before we do that, let me go back. This blank right here, adding hours of cash vacation compensation. If you want to, this is purely optional, okay? If you want to see the effect of having that vacation compensation in your final pay that we're using to calculate your retirement, if you want to see what the effect of that on your salary, on your retirement benefit, you want to get an estimate of that, you can do that. And so you can do that in this benefit estimator, and I'll help show you what to put in this blank on your worksheet. There's an area on your worksheet to help you figure out what to put in, what number to put in here. So let me show you that area of the worksheet. Okay, so for everyone besides Alameda Health System people, we'll get to Alameda Health System people when we get down here, but we're going to start here. Okay, so for everyone besides AHS people, what you're going to put in this blank is your limit from the chart. So remember from the other part of the worksheet. Let me go back to the worksheet real fast. So this is on page 2. It's this number right here, your limit from the chart. You just put that number over in here. Okay. Then you put in your weekly work hours here, and you multiply those two together, and that's going to give you your limit in hours. So we knew what your limit was in weeks. We're multiplying it by the hours to get your limit in hours. Okay, for the AHS people, we already knew what your limit was in hours. So you put that in here. Okay, now we know what your limit is in hours. Now what we're going to do is put in here, we're going to look for the number in this blank. We're going to look for hours of vacation that you sold during the salary date range that you're using for the estimator. So what you're going to do is just run the estimate one time normally without putting anything in that blank. And then you're going to come over to the estimator and you're going to look at this date range here that it's using to calculate your salary projection. And you're going to think about, did I sell vacation during that date range? If you don't remember, you can go back and look through your payroll records. If you really don't remember and you don't have your payroll records, you could contact Sarah for that info if you want to try that out. So you put that number in here. So let's say in this example, I'm going through this and I look at this date range and I go, oh yeah, I remember selling a week of vacation a year ago in this date range. So you would put that in here. What you're going to do is take your limit and subtract the amount you've already sold, and that tells you how much to put in the estimator. What I'm helping you do with this part of the worksheet is I'm helping you not overestimate, because in the estimator, if you've already sold vacation during the salary date range that it's using to get this number is already higher based on the vacation that you sold because your pay was higher during that time. So you're not going to want to put up to your limit in here. You're going to want to subtract that out. So that's what that part of the worksheet is helping you do. So then you would put that number in here, 56 hours. And then you hit get estimate. And you will see that, and so then this is your retirement allowance estimate. For right now, you can just look at this number right here for your estimate, because this is the highest retirement allowance, the unmodified option, but we'll talk about each one of these 5 options later on in the presentation. Okay, so then you take that number right here from the and then you put it right in there. So this is your precision estimate number. So if you want to fill out the worksheet just to remember what you did, you could put in your separation date, your projected retirement date, and then the hours of cash vacation compensation that you got from that one area of the worksheet. Put that in here, and then you can put your precision estimate that you get from the estimator into here. Okay, just to keep track of all the numbers. So the worksheet is just to help you keep track of all these numbers. If you don't want to do any of that, that's all super confusing for you, um, you can submit an estimate request to us and we will do the estimates for you. Um, so when you submit an estimate request to us, what happens is one of our staff members gets the request and then they do the calculation and they'll send you a letter in the mail for a couple of retirement dates that you are wanting an estimate for. Now, what happens with that is that you're going to go into a queue because we get a number of these estimate requests, and it's going to be based on your retirement date. Excuse me. It's going to be based on how far away your retirement date is. If it's closer, you're going to go up to the top of the queue. So that you could be waiting for a few weeks to get this number back. So this could take some time. Versus using the benefit estimator, which is just this. It's the same software. You're going to get the same result. You can do as many of those estimates as you want. That estimator is available 24/7. What you end up with is that estimate. This is a PDF, so you can save all of these PDFs for however many different retirement scenarios you want to save them for. And it's a really nice system. And if you don't want to get complicated, just do the scenario based on these dates and just hit get estimate. And it'll just, don't worry about this. And it'll just give you a nice estimate. Okay. And a nice conservative estimate. Okay. So those are the three ways to get a retirement estimate: using the ballpark method, using the precision method on the retirement calculator online, or submitting a retirement estimate request to us for us to calculate it for you. Okay, next topic. The next item in the checklist is verifying your eligibility to actually be able to retire. So we're talking about this milestone on the pension milestone timeline. This is your retirement eligibility date. It's based on your age and your years of service credit. Okay. So for tiers 1, 2, and 3, you can retire. You're eligible to retire if you meet one of these three scenarios: options 1, 2, or 3. Option number 1 is that you are at least age 50 or older, and you have at least 5 years of service credit. You've earned at least 5 years of service credit, and you have at least 10 years of membership in ACERA. And these numbers are different because you could stop working after 5 years and become what we call a deferred member, which is you stop working and you defer your retirement to a later date whenever 10 years passes from your date of membership. So it has to be at least 10 years from your date of membership in order for you to retire in this scenario. For people who are just going to work it straight through and go work straight into retirement, you just want to think about it as being over age 50 and having 10 years of service credit. And then you're eligible to retire. Option number 2 is that you can have, as a general member, 30 years of service credit, or as a safety member, 20 years of service credit, and retire at any age, even if it's younger than age 50. So that's option number 2. Option number 3 is you can be age 70 and have any amount of service credit. So you can even have less than the 5 years required for option number 1. You can have 4 years or 3 years and retire at age 70 and get a lifetime retirement allowance. Now, the retirement allowance will be pretty small because it'll be based on a small amount of service credit, but it'll probably pay some of your bills in retirement. For tier 4, you have to meet one of these two scenarios. Option number 1 is that as a general member, you have to be at least age 52, or as a safety member, you have to be at least age 50, and you have to have at least 5 years of service credit. So you don't have to do that 10 years of membership thing. It's just 5 years of service credit. And then you have the same alternative for being age 70 and having any amount of service credit. So that's option number 2 for you. You can be age 70 or more and retire with any amount of service credit. So now that you know What your retirement eligibility date is, you can go ahead and put that in here if you like. If you already happen to know you're eligible to retire, you leave it blank. The retirement eligibility date isn't really important for anything besides knowing that you are eligible to retire. If you already know you're eligible to retire, don't worry about it. Okay. So, next topic. Next item on the checklist, choosing your retirement date. What kinds of things do you need to think about when you're choosing your retirement date? Because you're the one that's choosing what day to retire. We're not doing it for you. It's going to be up to you. We're talking about this date right here on the pension timeline. Here are the things that I think that you should consider when finding the best day to retire. Okay, so let me answer this question real fast. Um, if you are already ready to retire and you have your counseling session, your ready to retire counseling session, which is in the 60-day period before your retirement date, and you change your mind during the session or anytime before your retirement date, then you don't have to retire. You can write us a letter and just say sign it. Just say take my retirement application out of the system, and then you can just wait. Okay, so you don't have to retire until your retirement date passes. And I'll talk a little bit about that when I talk about the retirement application process. Okay, so finding the best day to retire. These are the 7 things that I think you should consider. Number 1 is kind of basic. Will you have enough income in retirement? So you're going to want to go ahead and do that retirement estimate in one of those methods that I showed you. It's also a good time to look at your deferred compensation account if you have one, a 457B account, or any other accounts you have from previous employers like 401ks, 403bs, IRAs, any other retirement accounts. You're just going to want to look at how much money you have in there, and then go ahead and do the Social Security estimator. Social Security is going to give you an estimate. It's a calculator on their website that tells you how much they will pay you out of the Social Security that you've earned in different retirement scenarios. So you just want to get a picture of what your retirement income is going to be, because you're also going to want to think about your post-retirement expenses, because financial planners will tell you that you're going to need 70 to 80% of your pre-retirement income. So this is the income that you're making as a working person. You're going to need to be bringing in 70 to 80% of that amount in retirement in order to maintain your standard of living. So that's kind of a kind of a target number that you might want to be looking at, and you're going to get to that number through these sources of income: your SERA pension, your Social Security payment, and any other savings that you have. So you're just going to want to make kind of a retirement picture ahead of time, and then think about your post-retirement expenses and whether you're going to be able to pay for your life in retirement. And then if not, maybe you work another year, or maybe you change your retirement plan a little bit so that maybe you live somewhere else that is less costly, or maybe you find some other way to reduce your expenses. So it's just a suggestion to think about this ahead of time so that you're not in retirement and then wondering how you're going to pay for your life. Okay. Number 2 thing to think about, those age factor percentage days. So if you have not yet reached the maximum age factor for your tier, you're going to want to think about these age factor percentage days when choosing your retirement date. If you're already over that maximum age factor for your tier, then you can skip this. So I'll give you an example. If your birthday is January 15th, 1 quarter after your birthday is April 15th. 2 quarters after your birthday is July 15th. 3 quarters is October 15th. So every time you pass one of these days, you go up 1 notch in that age factor percentage chart, and you get a slightly higher age factor percentage. So let's take a scenario. You decide you are going to retire. Let's say that you're a tier You're a general member, you're age 60, so you haven't yet achieved the maximum age factor percentage, and you think you're going to retire on July 14th. Okay, obviously, you don't want to do that, because if you work July 15th and retire July 16th, you're going to get a slightly higher age factor percentage. That's going to increase your retirement allowance by a little over 1% just by waiting 2 days. Okay. So the same is true for all of the other ones. You work that day, you retire the day after you pass that age factor percentage increase day, and you go up one notch in the age factor chart, and you get a little bit like a 1% increase to your retirement allowance. So I'm showing you these days because you just want to be cognizant of those days. Don't pick a day that's right before the age factor percentage day. Just work through it, and then you'll get a little boost to your retirement allowance immediately and for the rest of your life. Okay, another date to consider, and this goes to the question that I had early on in the presentation of what's the deal about retiring on April 1st. So the deal with that is that's the cost of living adjustment day. So one of your vested benefits is a cost of living increase annually to your retirement allowance. The cost of living increase is posted to all of our members, all of our retirees who are in retirement status as of April 1st. So people who've already been retired for some years, when April 1st comes around each year, they just get the cost of living increase. For your first year of retirement, what happens is you retire, and then when the next April 1st comes around, that becomes your first cost of living adjustment day. So, and April 1st can even be your first day of retirement. So this is actually incorrect here. I'm not sure where I have that. April 1st can be your first day of retirement, and March 31st would be your last day of work. The cost of living increase is based on inflation in the Bay Area. So whenever inflation is in the Bay Area, the consumer price index, prices go up December to December, whatever that percentage increase is in prices, that becomes the cost of living adjustment. But there's a maximum amount of increase we can give you per year, and that's in the law. For tier 1 and 3 members, it's 3% maximum cost of living increase. For tier 2 and 4 members, it is 2% maximum cost of living increase. So what happens if inflation is more than the maximum increase? So what happens if inflation, let's say it's 5% from December to December one particular year? Well, everyone who's in retired status on April 1st will get the maximum amount for their tier. Tier 1 and 3 members will get a 3% increase. Tier 2 and 4 members will get a 2% increase. And then the additional percentage points will go into your COLA bank. We'll save those for you for future years when inflation is less than the maximum. And then we'll take percentage points out of your COLA bank to get you up to your maximum. So that means that if you've been retired for at least a few years, almost everyone has percentages in their COLA bank that we use to keep them at their maximum. So after a few years, you can just think about getting the 2% or 3% increase. And we do all this automatically for you. You don't have to think about it. Okay. So this kind of talks about the question regarding timing around choosing your retirement date, around choosing April 1st. Let me just go ahead and say that there's nothing really magic about retiring April 1st or retiring in March, because the reason that people will retire on April 1st or in March is because they're already ready to retire, and then they're thinking, okay, if I retire now on or before April 1st, I'm going to get an immediate increase to my retirement allowance. So I might as well just go ahead and do that, because if I wait a month and I retire like April 2nd or April 15th, I'm going to miss the cost of living adjustment for that year. I'm not going to get that immediate increase. So yes, there is a time period after April 1st where it would have been more advantageous for you to retire before April 1st. But then it quickly resolves itself, because you end up earning more retirement as you go throughout the year, and then it'll beat whatever the cost of living adjustment is. So if you want to retire in January, it's fine. When April 1st comes around, you'll get the cost of living adjustment. If you retire in September, totally fine. When April 1st comes around, you'll get the cost of living adjustment. It's just that, like, retiring right after April 1st, you know, you might want to think about dialing that back a bit and retiring on or before April 1st to get the immediate cost of living adjustment. Okay, so then what happens if the age factor percentage date, if your age factor percentage date based on your birthday and the COLA are in conflict? So in this scenario, you're thinking about retiring in the spring, um, and let's stick with the January 15th birthday again, because that's nice and easy to do. And in this scenario, you're a general member age 60, and the reason I'm saying this is simply because you are you've not yet reached the maximum age factor for your tier. If you are a safety member and you're under age 50, or as tier 1 or tier 2B, we're talking about the same thing. Okay, so you're thinking about retiring in the spring, and you're thinking, in this scenario, my birthday is January 15th. Should I retire? Should I work the 1/4 date after my birthday, April 15th, and retire on April 16th? Or should I retire on April 1st? If I retire on April 16th, I will get the age factor increase for having passed the date April 15th, but I will miss the cost of living adjustment that I could have gotten had I retired on or before April 1st. Or should I retire on April 1st, and I'm going to miss that age factor increase that's going to come in 2 weeks by working on April 15th and retiring after that. But I'll get the cost of living adjustment because I'm retiring on April 1st or before. Which do I do? Well, you probably already know the answer to this because I already told you the percentages. If the cost of living adjustment is the maximum for that year, and we always know that in early February, that's when we calculate that, you're going to go with the cost of living adjustment because that's going to give you a 2% increase for tier 2 or 4 and a 3% increase for tiers 2 and 1, which is going to be more than the increase you would have gotten waiting 2 weeks and missing the cost of living adjustment, but getting that age factor increase, which is a little over 1%. This is only if you have a dilemma, but you're going to retire in the spring and you have a dilemma between these things. Somebody had written in and said their birth date, like either birth date or quarter age factor day was in early March. Well, that's great for you because you can pass your birth date, and then you can, which gets you the age factor percentage, and then you can also retire on or before April 1st and get the cost of living increase. So you can get both. So in this scenario, this person's age factor increase day is just a little bit after the April 1st day, which is where the conflict comes in. Now, if you're not going to retire in the spring, let's say the same person is thinking about these scenarios and then thinks, well, I'm actually going to work another 3 months, earn a little bit more retirement, retire in late July. That's going to beat the cost of living adjustment because you're going to get 2 age factor increases, one for April 16th, one for April 15th, one for July 15th. And then, so you're going to go up 2 notches in the age factor column. And then in the service credit column, you're going to earn 3 more months of service credit. And that'll beat the cost of living adjustment. So it'll be better. You'll get a higher retirement allowance that you've earned retiring than you would have gotten had you retired in April. So that's why there's this period in April and like right after April that it would have been better for you to retire before April, but then that quickly resolves itself throughout the rest of the year. Okay, next topic. The next thing that you're going to want to think about when choosing your retirement date is you're going to want to retire on the day after your last day of work, if you're going straight into retirement. For the deferred members, the deferred member that's in the webinar, you don't even have to worry about this. because you've already stopped working and then you've deferred your retirement to a later date. So these are just for the people who are planning on working straight into retirement. You retire on the next day. Your first day of retirement is the next day after your last day of work or active employment status. It's okay if you're on leave this day. Okay. So that is going straight into retirement because you're not spending any days as a deferred member. And the reason that this is important is because you will do that sick leave conversion for you because you've gone straight into retirement. Okay. Another thing to think about that's similar is that you want to retire after a day that you are already scheduled to work. So you retire on a non-holiday day where you're scheduled to work the day before. Okay. So for example, if you work Monday through Friday, you don't retire on Sunday or Monday. That's not your first day of retirement because on Saturday, the day before Sunday, and on Sunday, the day before Monday, you are not scheduled to work. And so that's going to be a problem. So you just want to make sure you your first day of retirement is a day that you're already scheduled to work. If you're somebody who has a inconsistent schedule, you just look at your schedule for that like final week of work and just pick the next day after a day that you are scheduled to work. So it doesn't have to be on a Friday. It could be any day of the week as long as you're retiring after your last day of an active pay status and it's a day that you were scheduled to work. Now, there's a question here. Is it okay if your last employment day is a holiday? So I'm telling you to retire on a non-holiday, but the question is it okay if the day before, so I'm saying don't let this day be or let's say that you're retiring Thursday and let's say it's 2 days before, Thursday and Friday, and you're trying to retire on this day and this is going to be your last day of work. And this day is a holiday. So I'm telling you don't retire on the holiday. Now the question is it okay if the day before is a holiday? I think it's okay. I don't remember the answer to that question. That would be something that you would want to address during the counseling process. There's some, I can't remember the reasoning behind that, but I think it's okay if the last day of employment is a holiday. It's just that you don't want for your first day of retirement to be on a holiday. Okay. And finally, the last thing that you want to think about when choosing your retirement date is don't retire on July 1st. Pick any other day. Because all of those vacation compensation limits I told you about when we were talking about how much vacation compensation could be included in the salary calculation, all those limits are lower if you retire on July 1st because you're retiring exactly lined up with the fiscal year. Now, you don't really need to understand why it's the case, just pick any other day. June 30th, wonderful day to retire. July 2nd, beautiful day to retire. Okay, just don't retire on July 1st. So going back to the worksheet, now that we've gone through the different things that you want to think about when choosing your retirement date, maybe you have a better idea of what your retirement date is going to be. And so you could go ahead and fill it in right here if you like. You also probably know now what this separation date is going to be. Because if you're thinking about your retirement date, maybe you weren't thinking about your separation date. Well, if your retirement date is going to be, if you figure out what your retirement date is going to be, and you're going to go straight into retirement, you just pick the day before. That's your separation date. Okay. So here's the next item in the checklist. Applying to retire. What does this process look like? Your first step in the application process is that you should go through our preparing to retire section on our website because there is some pertinent information in there For example, there's some documents that we need to have on file. If you've ever changed your name from what it is on your birth certificate, there's some information there. We talk about changing your web member services username, which is your email address, and so on and so forth, notifying your department. So there's some various steps in there that you're going to want to go through. Okay, next step is that you're going to want to 3 to 6 months ahead of time, before the date that you've chosen for your retirement date, you're going to want to set up a ready to retire counseling session with us. Now, we have just posted a new form on our website that helps you set up that counseling session. So it asks you a bunch of questions, and it's kind of like a pre-screening that helps us know what your situation is going to be. And then we will contact you to set up that ready to retire counseling session. So you're doing it in the 3 to 6 months before your retirement date. And we will set up that session for the 60-day period before your retirement date. And we are currently offering those counseling sessions over the phone. And I believe we're going to start offering video counseling sessions as well over Zoom. So you'll get your full counseling session, even if you can't come into our offices. So then the next step is that within the 60 days before your retirement date, you're going to submit a retirement application. On the application, you're writing down what your retirement date is going to be, and you're submitting it to us. And make sure it's within the 60 days before whatever date you're writing down in the application. So we receive your application, we input it into our system, and then we record what your retirement date is going to be. And once that date passes, you're retired. So, woo! It's amazing. You're going to be retired. So it's going to be a celebration day. But there was a question earlier: what happens if during the counseling session or anytime after you've put in your application, you change your mind? Well, you can just write us that letter and sign it. Just can say something quick like, "Dear Sarah, please take my application out of the system. I've changed my mind about my retirement date." And then you sign it. You send that in to us, and we'll take your application out of the system. Okay, the next step is you're going to select one of 5 retirement options on this option election agreement, and you're going to receive that before your counseling session. It's possible in the future we may include that as part of the retirement application. So we'll see what happens with that. Your retirement application and your option election agreement you could submit at your retirement counseling session. If you're not going to do your retirement counseling session, there are instructions on our website about how to submit these if you're not going to come to a counseling session. And then once your retirement date passes, you're retired. It's amazing. Okay, I have some questions here. Your first name on your birth certificate and your name on your social security card are different. Is that a problem? I'm not sure. That would be a good question to write in on our contact form. If you go to acera.org, there's a contact us link, and you can just send in a quick question and we can get back to you on that. I'm not sure. Question: is your retirement income taxable? Yes, it is, because you have been contributing to the retirement fund on a pre-tax basis. So you haven't been being taxed for that income. So you're going to have to be taxed on disbursements from the retirement fund. So you will have to pay income taxes on that. And there aren't special income taxes for retirees. It's just the same old tax tables, the same tax brackets that everyone else pays taxes under. You just will file your taxes as usual, and we'll send you a 1099 every year in January that tells you what your taxable income is from Acera, and you can use that to file your taxes. Okay, so back to the worksheet. Now that you know what date you should call in for the Ready to Retire counseling session, the 3 to 6 months, what you could do is just take this projected retirement date, subtract 6 months, put that date in there. And you can circle this because this is something you're going to need to remember to do. Call in for that counseling session. So regarding when you're going to receive your first retirement check, you're going to get that 4 to 6 weeks after your last employer's paycheck. It's going to be, we've refined our process so that the vast majority of people get whatever their 100% retirement allowance is straight from the start. But if there's any major issues with your file, such as these, you're going to get 80% payments until we resolve the issues, and then you'll get retro payments for any 80% payments that we made. Okay, so this is the part of the presentation where I walk you through your 5 retirement allowance options. This is what you're going to be choosing on your option election agreement, or possibly on your retirement application if we merge that into the retirement application. And you choose this at the time of retirement. So you don't need to really choose this before. You can be way before you can be thinking about it, but you make your selection at the time of retirement, prior to retirement. And your selection is permanent. So whatever you choose, that's going to be your option for the rest of your life. Okay, there's 5 options: the unmodified option and options 1 through 4. For each one of the options, I'll show you a slide that has a lot of text on it. Sorry about the text-heavy slides, but there's a lot of nuance here between these options. So just to break it down a little bit, what's going to be up here is going to talk about your retirement allowance that you're going to receive as a retiree in your retirement. And this down here is going to talk about what your beneficiary will get after you die. So your beneficiary, that word just means somebody who gets benefits. Your ACERA beneficiary is somebody who gets whoever you designate to get your ACERA death benefits. So that's your ACERA beneficiary. Okay. So the unmodified option. When you go to retire and you select the unmodified option, this is going to pay the maximum retirement allowance to you, the retiree, of any of the other options. This is the option that the vast majority of people choose because it pays the maximum retirement allowance. So then when you pass away, this will pay a 60% continuance to an eligible beneficiary. So your eligible beneficiary is a spouse or state registered domestic partner who you have married or registered at least 1 year before your retirement. They will get a lifetime continuance. Now, continuance, that word just simply means a continuing payment. So you're getting your retirement allowance every month for the rest of your life, and then when you pass away, your beneficiary will get a continuing payment every month. And if it's a spouse or state registered domestic partner, it will be for the rest of their life. And that amount is going to be 60% of whatever you are receiving as a retiree. If you apply for and are awarded a service-connected disability retirement, that goes up to 100%. Okay, let's say that you don't have a spouse or state registered domestic partner to name as a beneficiary, but you do have a minor child or minor children. You can name them for the 60% continuing payment, this continuance, but it's not for the rest of their life. It stops at age 18 unless they maintain enrollment as a student in a full-time student in an accredited school, and then it can continue until age 22, at which point it'll stop. And it'll continue until that point unless they get married or register a domestic partner with the state, and then it will stop. Okay. Maybe you don't have a spouse, state registered domestic partner, or minor children, but you still want to select the unmodified option. Absolutely do it, because like I said, the vast majority of people select this option because it pays the most to you as a retiree. Now, you can name a beneficiary, but it's not going to be for continuance because you don't have one of these qualifying beneficiaries for this option. But you can name a beneficiary for a lump sum payment. And the lump sum payment is going to be basically the balance of your contribution account. So it's going to be your employee contributions that you've paid into the system throughout your entire career, plus all the interest that we've paid on top of your contributions, because the fund, whenever the fund earns interest, we pay interest, minus all of the payments that we've already made to you as a retired person, all of those monthly payments. So if there's a balance left over, we'll pay that out in a lump sum to a beneficiary or beneficiaries. Now, one thing about this is that there's not going to be a balance left in there if you are retired, if you pass away after the first 3 to 5 years of retirement. So there's going to be no lump sum balance for the lump sum beneficiary. So that's the bad news. The good news is that means that everything that you paid into the retirement system throughout your entire career, plus all the interest that you've earned on top of that, we're going to give you back in retirement payments within that first 3 to 5 years of retirement. And every retirement payment that you receive after that for the rest of your life is just a bonus. It's like pure profit for you. It's amazing. And I say it's a bonus and it's profit. I kind of use those terms just to to show you the idea that you paid in this system and you're going to get a very nice retirement benefit because of having paid in the system and spent so many years earning the retirement that you've been earning. And those additional payments, what allows us to do that is your employer paid into the system, but mostly it's the interest that we've earned on over your career from those employee and employer contributions. And the interest actually pays for 75% of your lifetime retirement allowance. So it's a really cool system, and it's a really big benefit that you get to participate in the system and have that secure lifetime retirement allowance every month for the rest of your life. It's pretty special. Okay, that's the unmodified option. Oh, let me point out one more thing on the unmodified option. There is a scenario where you had a qualifying beneficiary. Let's say you had a spouse at the time of retirement, you name them as your continuous beneficiary, but then they die before you do. Okay, you can name a new beneficiary in retirement as a retiree, but not for a continuance. The only time you can name a continuous beneficiary is at the time of retirement. So whatever new beneficiaries you're naming in retirement because your continuous beneficiary died before you did, those would be for lump sum payments. Now, even if this amount runs out, there's some additional lump sum payments. For example, the $1,000 lump sum death benefit, any partial months of retirement allowance that we owe you at the time of your death. If you paid into our healthcare plans a month in advance, which you normally do, we'll refund that money. So there are some lump sum payments that will go out to your lump sum beneficiary. Okay, that's the unmodified option. Option number 1 is the only one of the 5 options that doesn't ever pay a continuance to anyone at any time. What this does is this pays you, the retiree, a little bit less than the unmodified option. It's just a little bit less. What it does is through the power of accounting, it will extend that 3 to 5 year period that there's a balance left over for a lump sum beneficiary to 10 to 12 years. So if you die within the first 10 to 12 years, there would be a chunk of money left in there based on your contributions and interest for your beneficiary. So that's option number 1. Option number 2, this does a couple of things. So first of all, you're going to keep seeing this. This is going to pay less than the unmodified option. They all pay less than the unmodified option. Okay, the 2 things that this does, the first thing it does is it allows you to leave 100% continuance to your beneficiary rather than a 60% continuance. So whatever you were getting paid as a retiree, your beneficiary is going to get 100% of that. The second thing it does is it allows you to name anyone as a beneficiary. And you can cross this out. Anyone with an insurable interest, it's just anyone. This is old info. Sorry, that's still in there. You can name anyone as a beneficiary. And It's not just spouse, domestic partner, and minor children. So you could leave 100% continuous to anyone. Now, a few caveats. The reduction in how much less this pays than the unmodified option is going to be based on your beneficiary's life expectancy. So if they're significantly younger than you, we expect them to have a long life. We're going to have to pay the beneficiary more. We're going to pay you less as a retiree. And that's calculated at the time of your retirement and for the rest of your life. And if your beneficiary dies before you do, we don't increase your benefit. So whatever your retirement is calculated to be at the time of retirement, that's your retirement allowance for the rest of your life, plus cost of living adjustments. Okay. Option number 3 is very similar to option number 2. Almost everything is the same as option number 2, except the amount that it pays to the beneficiary. So rather than paying 100% of whatever you were getting as a retiree to the beneficiary, it pays 50%. So they get half of whatever your retirement allowance is as their lifetime monthly continuance. Because it pays less to the beneficiary than option 2, it's going to pay you as a retiree more. So this pays more than option 2, but all the same rules apply as option 2. Option number 4, the final option, is the option where you can name multiple beneficiaries for a continuance. So the other options, the unmodified option, option 2, and option 3, where you can name a continuance, you can only name one beneficiary. The exception to that for the unmodified option is you could name more than one minor children, more than one minor child, but it's a temporary benefit. It's not a lifetime benefit. So for lifetime benefits, option 4 is the one where you can name multiple beneficiaries for a continuance. The reduction on how much it's going to be going to pay you, the retiree, less than the unmodified option is going to be based on the youngest beneficiary's life expectancy. And you can name a dollar amount or a percentage split among the different beneficiaries. So you can do 50-50 or 60-40, whatever you want to do. So those are the 5 retirement allowance options that you will be choosing from. In order to get an estimate, because I keep saying the other ones pay less than the unmodified option, well, how much less? Well, what you do is you go do a benefit estimate. So again, this is a screenshot of the benefit estimator. You put in your retirement scenario, you put in your beneficiary, make sure this is correct to get an accurate picture of what your beneficiaries will receive. Make sure that the date of birth is correct. If you select a beneficiary you've already named as an active member beneficiary from the dropdown, make sure that the date of birth is correct, because some of them aren't. You hit get estimate, and then you're going to get your benefit estimator again. So I'll zoom in to the estimate part, and you're going to see that there is an retirement allowance estimate for each one of the options. Unmodified, here's your estimate. Option 1, here's your estimate. Option 2, option 3, these are your estimates. Okay, so this is going to be your monthly lifetime retirement allowance estimate. For option number 1, you get a couple of other numbers here. This is going to be the balance of your account that is going to be reduced each time you get a retirement allowance. So it's just giving you these two numbers to give you an idea of how long that money is going to last for your lump sum beneficiary. And then this number right here is going to be the amount of that balance that's going to be reduced by every time you get a retirement allowance payment. So if you want to know how long that money is going to last in there for your lump sum beneficiary, you just take this big number and you divide it by the little number, and that'll tell you how many months that money will last. Okay. And then you could even divide by 12 to see how many years it'll last. And like I said, it should last 10 to 12 years. If you die within the first 10 to 12 years, there would be a lump sum left for your lump sum beneficiary. The beneficiary allowance box for option number 1 is grayed out because, like I said, it doesn't pay a continuance to your beneficiaries. Only the unmodified options 2, 3, and 4 do. So this column shows you what the continuance would be for your beneficiaries in this retirement scenario after you die. Sorry. You'll notice option number 4 doesn't provide any numbers because the math is a little complex, and so we have to send that to our actuary for calculation. And if you want an estimate for option 4, you should submit a retirement estimate request to us. Okay. So next topic, next item on the checklist. Other benefits that we offer. So let me help you understand some of those, or I'll help you understand all of them actually. We've been talking a lot about the guaranteed benefits, the vested benefits, the lifetime monthly retirement allowance, the cost of living adjustment, and some of the death benefits. Now that we also offer additional benefits on top of the guaranteed benefits, but they are not guaranteed. These are funded through reserve funds. This is something that the county and the other employers set up, this reserve fund, to help offer these additional benefits. And these are mostly healthcare benefits: medical subsidies, dental subsidy, vision subsidy, Medicare subsidy. And then there's a supplemental cost of living adjustment, which is paid on top of the regular cost of living adjustment that helps you maintain your buying power in retirement. So I'll go into detail about each one of these. First, let me show you this chart. The Board of Retirement sets the rules on who gets these benefits and how much and what the levels of benefits are, because they're trying to maintain sustainability of that reserve fund. So the rules that they have set, the current rules are that you need this amount of ACERA service credit to start qualifying for these subsidies. For the supplemental cost of living adjustment, you don't need, there's no years of service credit to qualify. It's 0. Everyone has access to that. But all the other ones start at 10 years of ACERA service credit. Then you are able to start qualifying for Medicare subsidy, dental and vision, and the first level of the medical subsidy known as the monthly medical allowance. And then if you have 15 or 20 years of service credit, you get higher amounts of the monthly medical allowance. So let me show you a little bit more about each one of these. And actually, let me pause for just 1 minute, and I'll come right back in 1 minute, just to give you like a quick breather. I'll be back in 1 minute. Okay, I'm back. Just to do a time check here, it is now about 11:30, and it's usually maybe 40 minutes out from this point in the presentation, so we might go about 10 minutes over, just to give you a warning. Okay. First, we'll talk about the monthly medical allowance, and then I'll talk about each of the other extra benefits. Like I said, none of these benefits are guaranteed. It's as long as there are funds in this reserve fund that are available. Currently, there's over $900 million. I think maybe last time I looked at it, there was almost $1 billion in that reserve fund. So there's a good amount of money in the fund to pay for these benefits currently. The subsidy, the monthly medical allowance, goes to offset the cost of ACERA-sponsored medical plans. So if you sign up for your own healthcare coverage outside of ACERA, you can't use the monthly medical allowance for that. And so we're going to have group plan options, and the monthly medical allowance pays helps you cover the premiums. And we're going to have individual plan options, and it helps you cover premiums, copays, and deductibles. The amount of the monthly medical allowance is set annually by the Board of Retirement, so it sometimes goes up from year to year, and the Board of Retirement will examine healthcare costs, and they will examine other factors like the sustainability of the fund when they're deciding whether to increase the monthly medical allowance or not. If the costs that you incur exceed the amount of the monthly medical allowance, you're responsible for paying those. And it's only available for you, the ACERA retiree, not your beneficiaries, survivors, or anyone else. Here are the monthly medical allowance amounts for 2020. So if you're an ACERA retiree enrolled in a one of ACERA's plans, these are the monthly medical allowance amounts that you would have access to. If you have 20 or more years of ACERA service credit, you're eligible for the full monthly medical allowance, which is $578.65. If you have more than 15 years, but not quite 20, you're eligible for $433.99. If you have at least 10 years of ACERA service credit, you're eligible for $289.33. And if you have under 10 years, you're not eligible for the monthly medical allowance. Okay, so consider these numbers and what scenario you're going to be in. And I'm going to show you the costs for the current medical plans, so you can see how much of the medical plans that these subsidies pay for. Okay, let me address that question in just a few minutes. Okay. Here are the medical plans, the group medical plans. These are the ACERA-sponsored group medical plans. We have open enrollment each November, so that's your opportunity to change plans, add coverage, take away coverage if you want. And there's two groups here that I've divided them out into. We have plans that you will select from if you're not yet Medicare eligible, plans that you will select from if you are Medicare eligible. Medicare is the federal government's healthcare system, and you are eligible for it generally once you turn age 65. There's a few conditions that put you eligible before that, but not very often. Okay, you can see there's three companies here: Kaiser Permanente, United Healthcare, and Via Benefits. So let's talk about the non-Medicare plans first. So here's the order I'm going to do it in: non-Medicare group plans, Medicare group plans, and then individual plans. If you want the full plan details, we publish this retiree enrollment guide every year, and you'll receive this in the mail as a retiree every year. And this has all of the plan design and costs and everything. Now, this is a PDF out on our website. Okay, so here are the group plan costs for 2020 group plans for the non-Medicare eligible. So you can see Kaiser Permanente HMO, the self-premium is $785.44. So you'll note that the highest level of the monthly medical allowance, which was $578.65, doesn't quite cover the cost of that. In fact, you end up owing about another $200, okay, to be enrolled in this plan, and that's the lowest cost non-Medicare plan. And then if you want to enroll your spouse or yourself plus one or your family, you can do that, and then co-pays for each one of the plans are $15. Now, the United Healthcare Signature Value HMO is quite expensive, And because of that, when the county last negotiated these plans, and they negotiate these for us, so you'll notice that they're the same plans that the county offers. They negotiated this United Healthcare Signature Value Advantage HMO plan, which is what these bullet points are talking about. And this plan is 23.5% cheaper than this plan. And it's because you have to stick to a designated high-performing network of healthcare providers like doctors and other healthcare providers. And what that means is there are these certain list of providers that they've deemed as more efficient, high performing, and if you stick to those, then you can get this much lower premium amount. And when the county studied it, they found that people who were already enrolled in United Healthcare Signature Value HMO, they were already going to the high performing network providers anyway. The vast majority of people, it was like 80 or 90% of people. So it's advantageous for you to just go ahead and select the lower cost plan because you're already going to those providers. Okay. Now, the way the monthly medical allowance works, if you're eligible for it, and this is just a super basic version of your Acera check stub that you would get in retirement, is you have your gross pay, that your gross retirement allowance amount. Okay. Then there's going to be a deductions column on your Acera retirement allowance pay stub. And if you enroll in one of our group healthcare plans, you'll see that premium amount come out of your check, because we do this for you. We'll take the premium amount out of your check and we'll send it over to Kaiser or United Healthcare for you. Then, if you're eligible for the monthly medical allowance, you'll see the monthly medical allowance amount go back into your check in the additions column. And you end up effectively paying the difference between the $200+ between these two amounts. And then you have your net pay down here. So one more thing about this is that the monthly medical allowance and all of these non-guaranteed benefits are not taxable income. We have it worked out with the IRS where these are not taxable. So this does not increase your tax liability by getting these. Okay, so like I said, before I get to the individual plan options for the non-Medicare eligible people, I'm going to show you the group plan options for the Medicare eligible people, and then I'll do the individual plan options for non-Medicare and Medicare at the same time because it's easier to explain together. So if you're Medicare eligible and you want to enroll in a group plan through Acera, your only option is Kaiser Permanente. The self-premium for 2020 is $411.54. Okay. There are a bunch of other different scenarios for your premium, and it's based on you enrolling additional people. If it's a spouse, it depends, like your additional amount depends on whether you're both Medicare eligible, only one of you is Medicare eligible, and then if you're enrolling your family, whether you're both Medicare eligible, whether only one of you are Medicare eligible. And there's 2 columns for each one of those because it depends on which one you are. It depends on your monthly medical allowance amount. So in this table, what I've done is I've taken the 20-year monthly medical allowance amount and put it in this row here just to show you how it subtracts out what your out-of-pocket cost is. So if you have at least 20 years of Acera service credit or even 15 years of Acera service credit, it's going to cost you $0 to enroll in this Kaiser Permanente Senior Advantage plan. It's a good idea to enroll in this. I get the question, what if I just want plain old Medicare? Yes, you just get plain old Medicare from the federal government, and you can do that. And you'll get a certain level of coverage. The reason that you might want to, as a Medicare eligible individual, enroll in additional coverage through Kaiser Permanente or through one of our individual plans that I'll show you in a minute is you get a higher level of coverage and a higher level of care. And so if you're in this scenario where you have at least 15 years of Acera service credit, it doesn't cost you anything. So another thing that you'll notice is that in this table I'm giving you, the monthly medical allowance amount is the exact same amount as the premium. And why is that? when you looked at the monthly medical allowance chart, 411.54 wasn't one of the three amounts? Well, it's because the monthly medical allowance only pays up to the premium amount. So you do not get to keep the change from the monthly medical allowance above the premium amount for the group plans. So it'll cover your premium cost, but not anything above that. And that's why the out-of-pocket cost is 0 here. Okay. So those are the group plan options. Let's talk about the individual plans. And I might answer your question regarding the individual plans during this discussion. Who can enroll in an individual plan? And you would be enrolling through this private health insurance exchange that we've contracted with. It's called Via Benefits. If you are not yet Medicare eligible and you live outside of our Acera group plan service areas, and so for all those group plans I just showed you, the service areas, they're a little bit different from each plan, but they're basically the same, which is San Francisco Bay Area, Sacramento area, Fresno area, and Southern California. And then additionally for Kaiser Permanente, I think they added Santa Cruz. So if you live in those service areas for those plans, you can enroll in those group plans. If you don't live in the service areas for the plans, it usually involves a radius from their facilities, then you can't enroll in the group plan. But then you have the individual plan options. So if you're not Medicare eligible and you live outside the group areas, you can enroll in an individual plan through Via Benefits throughout the entire US. For the Medicare eligible people, if you live anywhere in the US, even if it's within the group plan service area for Kaiser Permanente, you can still enroll in an individual plan. Even if you live in the Bay Area, you can enroll in an individual plan. Okay. How do these individual plans work? What happens is we contract with Via Benefits, this private health insurance exchange. And what they will do is they will help you find a plan that's right for you. They contract with 80 more different insurance carriers. They offer 1,000 different plans nationwide. What you will do when you want to enroll in one of these plans is you can go to their website or you can call them on the telephone. If you call on the telephone, you'll talk to a benefit advisor who is certified and salaried and non-commissioned. And I say all that to say that they're not biased. They don't receive an extra commission depending on which carrier that they get you in. Their whole job is to narrow down the plans to what's right for you. So when you call, you tell them where you're going to live, what level of coverage you want to have, how much you want to spend. You can even get as granular as what providers you want to go to or what prescription drugs you need, and they will help you choose from among all their plans. Okay. The monthly medical allowance can pay for these individual plans, not only for premiums, but for deductibles and copays as well. Okay. And so the way the monthly medical allowance works, if you're eligible for it, is a little bit different. The way that we provide it to you is a little bit different if you enroll in one of these individual plans. It doesn't come in and out of your Acera check. What happens is, sorry for these crude illustrations of just cubes, but hopefully this helps illustrate it for you. So here's Acera. And we have your monthly medical allowance ready for you here. Okay. So what we're going to do is we're going to send that monthly medical allowance over to you, Via Benefits. They are going to open up a health reimbursement account for you. And we put your monthly medical allowance into that health reimbursement account. So that is ready for you. Okay. So then over here, here's your bank account. Okay. You are going to incur some costs for this medical coverage. Some of those costs are going to be to your insurance company for being enrolled in the plan. Those are your monthly premiums. So you're going to have to pay them for your monthly premiums amounts. That's the cost of being enrolled in the plan that they charge you every month. You're also going to go to the doctor and you're going to owe copays. You're going to have to pay the doctor. Okay, so now you've paid money out of your bank account. What you're going to do is submit reimbursement claims back to Via Benefits, and they will pay you from your health reimbursement account the monthly medical allowance amount that you are eligible for to reimburse you for those costs. You can set up a lot of this stuff to happen automatically. Recurring payments to the insurance company, recurring reimbursements for your premiums to your bank account, and they'll help you set all that up. The main thing that you would have to submit reimbursement claims for are doctor's visits, and they have an app and a way on their website that you can do it all electronically. So they try to help you through that whole process. Okay, so let me address. Okay, let me show you. Let me see. Okay, so let me take this question real fast. The question is, why does it look better to pick an individual plan because you can apply it to deductibles, etc.? It depends on what kind of coverage you want and what carrier you want. So if you happen to love Kaiser Permanente and you want to stick with them, then you would be um, your only option would be to be in one of the group Kaiser Permanente plans, and then the monthly medical allowance amount would only cover the premiums. Now, if you do pick an individual plan, and this is kind of assuming that you're Medicare eligible, that you have the choice between Kaiser Permanente and an individual plan. There's a little more accounting and a little more setup that you have to do. So that's kind of something that you have to weigh. And also, you wouldn't be able to be in the Kaiser Permanente Senior Advantage plan. So that's something that you have to weigh. But otherwise, the main difference is like what carrier you wanna join, basically. The costs for just talking about the Medicare eligible plans between the Kaiser Permanente Senior Advantage and the individual plan, the premium amounts are actually much lower for the individual plans. And because of that, the Board of Retirement decided to create this slightly lower monthly medical allowance amounts for people who are Medicare eligible and enrolling via benefits plans. So these would be the amounts that you would be looking at. But we study it every year to see how many people run out of this money, and it's only about 10%. So for about 90% of the retirees, this amount of monthly medical allowance is sufficient to cover all of the costs. So it's kind of the answer for Medicare eligible people. For non-Medicare eligible people, you don't really have a choice. You either choose the group plans if you're in the service area, or you move out of the area and you choose one of the individual plans. Okay. Sure. Okay, so let's see. I have another couple of questions here. Okay, the question is, if you retire before Medicare age, but your spouse is of Medicare age and you wish to cover them in Kaiser, is there a calculation for this? Yes, common question. And it's actually already up on that previous slide that I was at. Okay, so it sounds like you're going to be doing self plus one. It's yourself plus your spouse. So you're going to be looking at these three. Okay, now you're not going to look at this one because you're not both Medicare eligible. So you're looking at these two. So the premium amount is the same in either scenario, whether you're the Medicare eligible one or your spouse is the Medicare eligible one. You're both going to be enrolled in Kaiser Permanente. If your spouse in your scenario is the Medicare age one, they are going to be in the Kaiser Permanente Senior Advantage plan, and you're going to be in the early retiree plan. We call you early retirees if you retire before Medicare age. And so this would be your premium amount. Now, your monthly medical allowance amount is going to depend on how much monthly medical allowance you're eligible for and which one of those people you are. In your case, you are you're the non-Medicare eligible one. So if you have at least 20 years of ACERA service credit, you would be eligible for the 578.65 because your part of this premium is actually higher than the monthly medical allowance amount, so it doesn't get capped. It doesn't get clipped at the Medicare premium. Now, if you're watching this video and you're the one that that is Medicare eligible and your spouse is not Medicare eligible, this would be your premium, but your monthly medical allowance in the 20-year scenario would only pay up to $411.54. So you can see the out-of-pocket amounts here. Now, if you look at our enrollment guide, there's a much bigger table for all of the different scenarios, for all the different monthly medical allowance amounts. So you can go into that guide and find out your exact scenario. Okay. Oh, in your scenario, you will only have 13 years of service. So you would have this monthly medical allowance amount, so $289.33. So just moving ahead. So you would be in this scenario. This would be your premium. $289.33 would be your monthly medical allowance amount. So you could just subtract this, your $289.33 from this number, and that would give you your out-of-pocket cost. There's a question: are plan selections permanent, or can you re-elect? And if so, is it annually or at the member's discretion? It is annually during our November open enrollment. You can switch plans, or during qualifying events. So qualifying events, retirement is a qualifying event. So when you retire, you can get right into one of these plans. And you have 30 days from qualifying events to change your coverages. Marriage, divorce, death, adoption of children, moving, your spouse retiring or losing their job. Those are all qualifying events, and you can change your healthcare coverage after those qualifying events. But otherwise, November is our open enrollment period where you can make those changes. Okay, so that's medical coverage and the medical subsidy, the monthly medical allowance. So let's talk about dental coverage and the dental subsidy. We offer two dental plans, Delta Dental PPO and Delta Care USA. Now, if you have at least 10 years of Acera service credit, you must enroll in one of the plans, but it doesn't cost you anything. This column is showing you that the self-premium and the subsidy are the same. So if you, for example, if you have at least 10 years of Acera service credit, you enroll in the Delta Dental PPO, $4204 comes out of your check. In the deductions column, $4204 goes back into your check. In the additions column, you pay $0 out of pocket. If you want to enroll Self Plus One, you would just subtract this number from this number to figure out how much you would pay out of pocket. If you have less than 10 years of Acera service credit, you can still enroll. It's voluntary, and there's a different set of premiums, and there's no subsidy. Do the plans cover adult children, and if so, up to what age? Yes, up to age 26. So if they are younger than 26, then the plans, you can enroll your adult children. The vision plans, let me say one more thing. Delta Dental PPO is a nationwide plan, so you can get coverage nationwide. Additionally, VSP is a nationwide. You can get coverage nationwide. So the vision plan is very similar. If you have at least 10 years of Acera service credit, you must enroll at least the VSP standard plan, but it doesn't cost you anything. The self-premium and the subsidy are the same. So you would see $424 go out of your check, $424 go back into your check. For vision, you have the option of buying into a plan that has higher coverages called the VSP premium plan, but you pay the difference between the premium for that higher coverage and the subsidy. The subsidy stays at $4.24. Okay. And again, if you have less than 10 years of Acera service credit, you can voluntarily enroll. Next benefit. This is called the Medicare Part B reimbursement plan. So if you are Medicare eligible and you want to enroll in one of Acera's medical plans, we mandate that you enroll in one of our Medicare medical plans. That's for a couple of reasons. One, it's cheaper for us because the plans are so much less expensive. And B, it's cheaper for you. Sorry, I did one and B. One and two, it's cheaper for you because um, the federal government is footing a lot of the bill. So it's cheaper for us to run the plan, cheaper for you. Now, when you enroll in Medicare, if you have paid into Medicare throughout your career for at least 10 years, so 40 quarters, then Medicare Part A is free. Medicare Part A is hospitalization. Medicare Part B is doctor's visits. Medicare Part D, like in dog, is prescription drugs. So Medicare Part A, the hospitalization will be free. Medicare Part B, however, is going to come at a cost. The government is going to start charging you a monthly amount out of your Social Security check um, to to be enrolled in Medicare Part B. The current minimum cost for that for 2020 is $144.60. What the Medicare Part B reimbursement plan will do is if you have at least 10 years of ACERA service credit and you fill out the application form for this, we will just subsidize for you the lowest amount that Medicare charges anybody for being enrolled in Medicare Part B for that year, which currently is $144.60. The bottom line is that Medicare Part B essentially is free for you because you pay the federal government $144.60, and then we pay you $144.60 into your retirement check. So that's how that works. If you're a safety member and you haven't been paying into Medicare because for some reason they don't have you connected to that, you can still enroll in Medicare. You can still enroll in Medicare Part A. And it's just that there's going to be a cost for being enrolled in Medicare Part A. And I think even if you're going to be in the Kaiser Permanente Senior Advantage plan, you may only need to enroll in Part B and not Part A. So you would want to call in. What you would want to do about that is if you have questions about that, you can call into our office and ask for the healthcare unit, or what happens is when you are about to turn 65 as a retiree, we're going to send you an invitation to attend one of our Medicare transition seminars. Currently, we're doing them as webinars only. And we will help you transition into Medicare at that point, and we'll help you enroll in this Medicare Part B reimbursement plan. We'll help you enroll in Medicare, and we'll tell you everything you need to know about that. And so if you wanted to check that out early, or you are somebody who's going to become Medicare eligible while you're still working, you can just go ahead and enroll in one of those seminars on the same page that you enrolled in this seminar, if you want to get that information. So that's how that works. Last benefit that we'll talk about is the supplemental cost of living adjustment. This is in addition to the vested cost of living adjustment. And what this does is it maintains your buying power in retirement at least 85% of whatever your original buying power was at the time of retirement. So if you ever lose buying power to inflation so much that it drops below 85% of your original buying power, then the supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power at the time of retirement. So it's a really good, a really important benefit because it keeps you losing more than 15% ground to inflation at any point in your retirement. There's a question, is assistance for enrollment in Medicare available if you retire before age 65? So if you happen to be one of those people where a qualifying condition puts you Medicare eligible before age 65, absolutely. We will help you enroll in Medicare, and you can definitely attend that Medicare transition seminar anytime you want. Anyone can sign up for that, and we'll help get you transition into Medicare. Or if what you're talking about is that you're gonna retire a little bit before 65, and you want to get help a little bit early, yeah, sure, absolutely. We will help you. We can get you, you can take the transition seminar early whenever you want, actually. Okay, so we're narrowing in on our last um, topic, which is understanding a few life events. Um, I'm not going to go into a great amount of detail on these topics because there's a lot of information out on our website about these, and they don't necessarily apply to everyone. But I'll just go through them briefly. Um, if you stop working before you are ready to retire, um, what we call that is deferring your retirement or becoming a deferred member, as I've been saying whenever it's come up a few times during the presentation. And you can retire out of deferred membership. So if you're ready to retire as a deferred member, you can just go ahead and retire and start drawing your lifetime monthly retirement allowance. Okay, there are death benefits that we pay out to beneficiaries of ACERA members who die before retirement. And you can read more about those on our death benefits page. And what that means is that one thing that I'll mention about that is that you should keep your beneficiaries up to date even before you retire. So who have you designated as a beneficiary? If you don't know the answer to that question, go ahead and log into your account on our website and it'll tell you. And if that person is incorrect, if you see your spouse in there from 3 spouses ago, go ahead and redesignate your beneficiary. You do that on our beneficiary designation form. And as soon as we get that form, your beneficiary is redesignated. If you divorce or dissolve your domestic partnership, either before retirement or after retirement, and you were married or you were in the state registered domestic partnership, and we're only talking about state registered domestic partnerships here. If you were married or you were in the state registered domestic partnership while you were working and earning your ACERA retirement, whatever portion of your retirement you earned during that marriage or domestic partnership, that is considered community property that is on the table for division during the divorce process or the domestic partner dissolution process. So so what you're going to want to do is understand how divorce affects your ACERA benefits. Go ahead and read that information on that page. Disability retirement is an option. So if you ever become permanently disabled and you cannot perform your job duties anymore, you can't wait for that regular retirement that you were planning on shooting for, you can retire early on the disability retirement. So that's something that you apply for. There's service-connected disability retirement if you got hurt at work, non-service connected disability retirement if you didn't get hurt at work, but you still are permanently disabled. So you can go ahead and read about that on our disability retirement page. And you can even give our disability unit a call. So you just call our main number, ask for the disability unit. If you want to work after retirement and you're going to go to work anywhere except for one of our 6 participating employers, have at it. We're going to consider you an ACERA retiree. We're going to pay you your monthly retirement allowance every month for the rest of your life. And you go work for wherever you want. Now, if you're going to come back to work for your current employer or for one of our participating employers, there are duration limits and restrictions that you're going to want to read about on this page. And then finally, if you relocate after retirement, so you move, go ahead and let us know, because we need to know where to send your annual report. We need to know where to send your open enrollment package to and any other official correspondence we need to send to you. And it can also affect what healthcare plans you can get into. So go ahead and read about that information on that page. And then the very last thing is if you want to stay up to date with what's going on at ACERA, the easiest way to do it is to subscribe to our email news. We don't send out very many emails at all. You're not going to get inundated every week or every hour with a bunch of marketing crap from us. Don't worry about that. We only send out important news. We hardly send out any news because there's just, not a lot changes, so that there's not a lot of important stuff to send out. So just go ahead and subscribe to our email news. It's super easy, and that's the easiest way to do it. Otherwise, you can just check our news page on our site for any important news. If you have questions at any time, give us a call. 510-628-3000. We have a call center. They're experts. They're there to answer your retirement questions. If they don't know the answer, they'll go ask somebody. Um, and so you're going to get the answer that you need. And currently, like I said earlier, during the shelter in place period, we are only taking live calls Tuesdays and Thursdays, but that may change soon. So check our website to see when we're taking calls, because we could open that up very soon. So I thank you very much for your time. Thanks for spending this time with me, um, going through and learning about your Sarah benefits. And on behalf of Sarah and the Board of Retirement, we really wish you a beautiful retirement. And thank you very much.